Hey everyone, welcome back. This is JoeLeMiracleMan, and this is a continuation of the last episode. This is episode 4. So we're going to continue the conversation about interest rate. We're going to go into which interest rate you should choose based on the overall picture. So here we go. I'll share my screen again and we'll continue where we left off last time. Now, because I was a financial advisor, I think big picture, right? My question to my clients will always, how long do you think you will have this mortgage? Now, the average person will come back and say, well, I don't think when I buy this house, I don't plan on moving till 20 years, till my, kids are out of college or out of high school. I'm like, okay, well, that wasn't the question I asked. I asked, how long will you keep this mortgage? Not keep the house, the mortgage. Well, 20 years, right? No, it's not. I mean, the average person refinances like every 7 years or so. Now, there's different reasons to refinance. Of course, interest rates going down, and our interest rates now are over 1% lower than they were last year. So, hey, a bunch of people are refinancing right now that got loans last year. Another reason is to consolidate debt. So I helped a couple pay off their car and pay off a student loan, and they consolidated that into the mortgage. Sure, their mortgage went up to $100 a month, but they saved $1,000 on the car payment and the student loans. So if you do the math, they saved $1,000, they had to pay $200 extra. They net savings of $800 a month. That's a lot. And they can do all kinds of other stuff with that $800 a month, such as, gearing up their retirement or doing home improvements or whatever. So there's other reasons than just interest rate. If you need cash for anything, some clients of mine their children are getting married soon and they want some extra money. They want to take some of the equity out for that. Other clients are doing home improvements. Other clients are taking equity out of their home because there's some good real estate deals right now. They want to buy investment property. So yeah, lots of reasons, not just interest rate driven. Some of those clients actually, one client last month increased his interest rate by 0.5%. You might think, oh my gosh, that's a lot. I'm saving, someone 0.5% in my scenario. But imagine increasing your interest rate 0.5%. But they're getting like $40,000 cash out. So hey, it's worth it to them, right? Why did I bring this up? I have clients who know that they're going to refinance in, let's say, 1.5 years or 3 years. Okay. A specific client I'm thinking about, they have a cosigner that helped them buy the house. And the cosigner said, hey, I'm willing to help you buy the house, but you need to promise me something. In 1.5 years, I want to buy my own house. So I need you to remove my name off the mortgage in 18 months. Okay, actually, I have two clients in that same boat. So about 18 months, both, their cosigner says, I want off the mortgage, within 18 months. So they know for sure they're going to refinance in 18 months. And there's other benefits of refinancing. Maybe, the loan to value will be lower, therefore lowering their PMI. They have PMI in this case, so that lowers it. It lowers their monthly payment, all kinds of stuff. So anyways, so keep that in mind. I'm going to work through this next scenario with an 18-month time frame. And this is where I would allow you to choose your own interest rate. Okay, so let's say you wanted to pay the $7,400 something dollars, right? Let me open up another. It's nice to have side-by-side, calculator here because I'm doing 2 sets of calculations. Okay, so what was that amount? Right there. 7,448. So if you're willing to pay this, okay, I'll get you a 3% interest rate. Let's see. Oh, I guess I don't want to get too into the woods, but you can see adjustments here. So there's the base price. You have adjustments based on these things. Conforming purchase. You actually get, well, that's so a 1% adjustment there. Let's see, the state that we're in. So you can see the adjustments. You have total adjustments, and therefore you get that. So that conforming purchase actually improved the pricing, and then these other things subtracted away from the pricing. So if you wanted a 15-year, you would not have that hit of 0.5%. Okay, so yeah, just wanted you to kind of be aware of behind the scenes, what goes into the pricing. Again, mortgage talk, the pricing of the rate, okay? Because think of each rate has a price, and you're buying the interest rate. So what interest rate do you want to buy? That's the question. The lower the interest rate usually costs more. Okay, back to my scenario here. So you got $7,448 as a cost. Okay, so let's compare the par rate of 3.375 and the buy down rate, or the lower rate. So you have the option to buy down the rate to 3% by paying the extra discount point there and origination fee. Okay, let's go to this software. This is my mortgage back office software. It's called Calyx Point. And I just got a sample scenario here. So I put in that rate, 30 years, that purchase price, that down payment, and here's the monthly estimated payment. So you got your principal and interest payment right here. Then you got your hazard insurance, which is, that's kind of an average number there. Of course, you can change that based on what deductible you choose, what coverage you choose. And hey, to shop insurance, one of my companies, we can shop 50 different lenders for you, or different carriers rather. So mortgages, lenders, insurance carriers, get them mixed up sometimes. And then taxes. So kind of what's typical for the Twin Cities is if it's a $500,000 house, it's probably close to a $500 monthly payment. Okay, so your total estimated payment, $2,428.36. Okay, so let's get our calculator back up here. Let's use this one. So at the par rate, you have that monthly payment. Okay. Now, what happens if you go down to the 3% and you buy down that rate? Okay, so let's take a look. Let's go to 3.00. Now, a lot of times the change is not as much as you would think. Now, keep in mind it is math based on the loan amount of $400,000. But let me just show you 1/8% and show you how much that changes. So to 400. That's $28 a month difference at a $400,000 loan amount. Now, if the loan amount was only, $200,000, it'd be about half of that. So we're talking $14 a month difference on 1/8%. So it's not as big as, usually the reaction is, that's it? It's only $28 a month? Oh, wow. Okay. Well, yeah, so let's go 3% though. So that's what we're comparing. Now we got 2,346 as a monthly payment. So let's subtract that. What's the difference? So 2,346.42. You would save $82 a month on your mortgage payment if you go from 3.375 down to 3%. Okay, and that's at a $400,000 loan amount. Now, the question again, is it worth it to invest $7,400 to save $82 a month? So that's the question. Okay, so how do we figure that out? Let's take, and I'm not even going to include the time value of money, but that is a real thing. So if you include that, sometimes these numbers get close to doubling. But let's exclude that, and let's just do the simple calculation. So you got $7,448 for as an investment, and let's see how many months it's going to take to at a savings of $81.96. It's going to take you 90 months to recuperate your investment. So that doesn't make sense, does it? 90 months divided by 12, it's going to take you 7.5 years. And you'll probably refinance by then. And then, and the time value of money is even going to be longer than 7.5 years, might be closer to 11 years. So again, how long are you going to keep this mortgage? If you told me 11 years, then I'd say, okay, it probably makes sense to invest that money, okay? But let's take it the next step. Instead of going 3.75, what if we went higher? So Joe, I'm seeing that these numbers improve or get bigger. What does that mean? Okay, we explored going lower. What about going higher? Okay, so the highest we can go for it to make a difference would be 3.875. So we're saying 0.5% higher than 3.375. Let's do the math and let's ask, does it make sense to go 0.5% higher in interest rate? And wow, I bet you've never been, suggested that before. Hey, why don't you get a higher interest rate? If you work with me, you're going to get a higher interest rate. I mean, that's crazy, right? Nobody talks like that. But I do. So, because I think big picture. Okay, so let's look at that a little bit. All right, what does it mean for cost? Okay, so we're going to go back to here. Let's go back to, so $400,000. Wait. First, before we do that, we got to take, what's the cost difference between the two? So we got 104% as a cost, and then minus 102 point, well, actually, I'm going to subtract it from the par rate, which is, well, no, to be fair, to be accurate, we got to subtract it from that rate, because even at 3.375, you'll get a tiny credit back, not that much, but a tiny bit. So let's go, okay. So you're gonna, instead of paying 1.8625 as a cost, you're gonna be receiving as a lender credit of 1.235%. Okay, so in dollars, what does that mean in dollars? You can see kind of credit fee here. So here you have, well, that kind of messes it up because par is 102.75, which includes the lender compensation. So it kind of messes that up. But okay, back to here. So you'll get a credit of 1.235. What does that mean in dollars? So turn this into a percentage and then multiply by the loan amount of $400,000. So you would get a credit of $4,940. So like, I'm going to give you this money at the closing, or the lender will, but so you'll get this money at the closing. So therefore you can pay less in closing costs. So you'll save about $4,900 in closing costs is what happens. But what does that mean for your monthly payment? Okay, so hey, higher interest rate, higher payment, right? Well, let's see how much higher it's going to be. We got to go back to here. If you remember, if you can see my original input here, 2428.38. So 2438.28. That was the monthly payment. Oh wait, I even did it wrong. So I'm glad I checked. Let's see. So 2428.38. Okay, and then compare that to 0.5% higher at 3.875. So let's see, what's the difference there? Now you saw the monthly payment increase to $2,540. Okay, so $2,540.95. That is $112.57 more as a monthly payment. Okay, so let me put this in a context. What if at the closing, now keep in mind, you're gonna refinance in 18 months, no matter what. So 4,940. I mean, assuming you qualify to refinance, you gotta have a job and the credit has to be decent and all that kind of stuff. But your friend, you made a promise, you're gonna refinance their name off the loan. Or maybe it's something else. Maybe you have PMI and in like 3 years from now, you're gonna refinance to get rid of PMI. There's all kinds of things. So maybe you're gonna do home improvements or whatever. So, okay, so 4,940. What if I gave you an interest-free loan of $4,940 at the time of closing? So I'm going to pay off a bunch of your closing costs for you. And it's going to be interest-free, okay? And I ask you to pay me back $112.57 per month. That's how much higher your mortgage payment's going to be, right? So you pay me back $112.57 per month. How many months for you to pay me off in full? It's going to take you 43.88 months. So almost 44 months to pay me off my interest-free loan, right? But what if you refinance in 18 months? So if you would have paid me back $112.57 per month for the next 18 months, you would have only paid me off $2,026. And if you refinance at that point, I'm going to forgive the remaining balance that you owe me. So I'm going to forgive it. So that means, so let's say that's a negative number. So I'm going to change it to, okay, so 4,000, the original, lender credit, or in my analogy, interest-free loan, 4,940, you paid me back 2,026.26. That means I'm going to forgive $2,913.74. That means you made a profit of $2,913.74 basically at the time of closing. So I'm giving you this lump sum money. You can take the 4,940, put it in a separate savings account, spin off, $112.57 per month to your checking account to help make the higher monthly payment. And then at the time of refinance, I'm going to forgive it. You get to keep the rest. I guess, so if you knew with a high likelihood that you're going to refinance in 18 months, why would you not choose the higher interest rate, right? But it's because maybe you didn't know about it. Your loan officer didn't educate you about it. They didn't give you the choice. They didn't allow you to choose your interest rate. But hey, for the right situation, that would work. And then again, the reverse. If you knew high likelihood you're not going to refinance in the next 7 years or 11 years, then hey, invest that money, get the lower payment, because after the break-even point of 11 years, the time value of money break-even, which is different than the simple break-even, then you're going to be making a profit every single month until the loan's paid off, for 30 years. So you have a choice. And if you don't know for sure, do something in the middle. So I hope that was educational, informative. Thank you for enduring the technicalities of it. I hope that you're more educated and you can make a wiser choice for you and your family on your next mortgage loan. If you choose to work with me, I will remind you of the education. I will give you the choice to choose your own interest rate and decide what's best for your family. And please like and subscribe if you enjoyed this video. Please give me some comments and also any questions that you want me to answer about mortgages in future episodes. Please direct message me or include in the comments. Thank you, and we'll see you next time.